how to become self-insured and design an IUL to actually become cheaper as you get older. The point is this. The cash value has equaled the death benefit, so the cost of insurance now is nothing. If you structure an IUL like I'm talking about, you'll be self-insured in 11 to 15 years. Your cash value will grow to equal and then exceed the death benefit. I'm going to explain something that I would say 99.9% of advisors out there simply do not understand, and it's pretty sad because you're going to be blown away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping people optimize assets, minimize taxes, and empower what I call their authentic wealth. My favorite financial vehicle to help them do that is one that passes the laser test with flying colors. Now, what's the laser test? The key elements of a prudent investment are, number one, liquidity, okay? The ability to access your money when you need it. Safety, not only of the institution, but safety of principal, and that any year that you make money, that becomes newly protected principal. Next would be earning a predictable rate of return, not pie in the sky, but I'm talking about tax-free rates of return in the 8 to 10% range, even though some years will be higher, some years will be lower, but averaging 10% tax-free would be like earning 15 or 16% in a tax-deferred IRA or 401k, because you'd only net 10 after tax, okay? And so my favorite vehicle is a properly structured, maximum funded, indexed universal life, and if it's structured correctly, which I'm going to talk about next, it is deemed a laser fund, because laser means liquid asset safely earning returns, okay? So in all of the books I've written, and I've authored 12 thus far, I've used this metaphor of a bucket. So this bucket represents metaphorically an IUL insurance contract. And so when people would come to me, they usually were not really looking to get more life insurance for death benefit. What they wanted is a better way to save for living benefits, for retirement income, for college saving for their kids and grandkids, for working capital for their business, for real estate management, for emergency funds, to use the money while they were alive, not to maximize what they leave behind when they died. That might be a nice benefit, but that wasn't the primary objective. So this was the brainchild of E.F. Hutton clear back in 1980 with the emergence of universal life. And so when you structure an IUL correctly, it'll knock the socks off of a whole life policy, because whole life was designed primarily to be used for death benefit and guarantee that the death benefit stays in force. Here, when you use max funded IUL, you don't need guarantees to keep the death benefit in force, because your cash value can equal and exceed the death benefit, often within 11 to 15 years. Why do you need guarantees when your cash equals and exceeds the death benefit within a decade instead of waiting 30 or 35 years for it to do that? And so let me explain how this works. If somebody came to me and they were a male age 60 and they're in decent health, what I do is I want to reposition assets to increase liquidity, safety, rate of return on the tax benefits on their underperforming or non-performing assets. They tell me which ones they want to reposition. So we might come up with a $500,000, let's say. And I've helped many people who they put in $5 million. Some put in $50,000. It doesn't matter, okay? But let's use $500,000, and let's say, simply put, $200,000 of that's coming from after-tax strategic rollouts from yet-to-be taxed IRAs and 401ks, and we're going to get the money out, and the tax is over and done with, and that's the net going in is maybe $60,000 a year or whatever for a few years, or $40,000 a year for 5 years or whatever. So that's $200,000, let's say. Now, let's say there's another $200,000 because this person is sick and tired of a rental property they have, and it's like an albatross around their neck. You can't believe how many people complain about, I just want to get rid of this property. I'm sick and tired of taking out the trash and fixing toilets and evicting tenants. And so they go, if I sell this rental home, what do I do with this 200,000? Okay. So let's say 200,000 comes from that. And let's say there's 100,000 sitting in non-performing banks, credit unions, or whatever, meaning very low rate of return. They're rowing upstream, metaphorically, so to speak, at 1, 2, 3 miles an hour. That's the interest rate. And the current of inflation is coming down. And so they're not getting anywhere. So now we come up with this number 500,000, 200,000 from a strategic rollout, 200,000 from a rental home that they are selling, and 100,000 that is underperforming in a bank or credit union. Okay. So now they want to reposition 500 grand over the next, 4 or 5 years. Knowing that I could buy a ton of life insurance for 500,000, but that's not the objective. I want the least amount of insurance the IRS will let me get away with. And I want to put it in as fast as the IRS allows so that this can generate 50,000 or maybe 100,000 or 200,000 a year of tax-free income when I'm ready. How do I do that? I take the least amount of insurance the IRS will let me get away with under the TEFRA and DIFRA tax citations. So based upon this male, his gender, his age, and his health. And if he's in poor health, even rated table D or whatever, I can squeeze down this death benefit even lower. But this guy's in good health, so the minimum would be about double what he wants to put in, $1 million. Okay. So he takes out $1 million of insurance, and what we want to do is we want his cash, as it is deposited in the IUL bucket, to qualify as being part of the death benefit. And all of the interest growth on the 500,000, we want it to be part of the death benefit. So which option do we choose? The level death benefit. You always choose the level death benefit if you're older and you're going to fund it within 5 or 10 years, because the spigot on the bucket, which is the cost of the insurance, will actually get cheaper as you get older. You only use the increasing death benefit for people in their 30s or 40s that are socking away a monthly amount for 20 or 30 years until they stop funding it. Then you switch to the level death benefit if you want to make the insurance become cheaper as you get older. Now, it's actually watering a nice little money tree at the end of the day that's going to blossom and transfer the money tax-free. But the objective is to have that spigot on the bucket be only about 1% of the gross rate of return at the end of the day, retroactive back to the very first day you started this thing. What does that mean? Well, because of rebalancing and diversification, I have averaged, ever since Index Universal Life has come out in 1997, 11.17, and I want my clients to net over 10%. They've actually netted 10.07. So to earn 11 and net 10, that means that 1%, which is the cost of the insurance and all the fees, is money that would otherwise go out the window in unnecessary tax, because they'd have to be earning 15 or 16% in a tax-deferred IRA or 401k to net 10 after all of the taxes and fees, okay? I only have to earn 11 to net 10. Now, I put in $500,000. Now, TAMRA, the Technical and Miscellaneous Revenue Act of 1988, where they lobbied Congress, who's they? The banks, the brokerage, the stockbrokers, firms, and so forth. They couldn't compete. So they said, we want to slow the flow, but we don't want to kill these because this is where we put our money. So basically, you have to spread it out over about 4 or 5 years. So let's say you put in $100,000 the first year. You can actually put in $100,000 the first day of the first year, and then you can put in $100,000 the first day of the second year. 1 year, 1 day, you can have now $200,000 in there. And then you put in another 100. So technically, the fifth deposit is 4 years and 1 day into this policy, if you want. I can now have maximum funded it with 500 grand. With whole life, it takes 7 years, okay? It's called the 7-pay test. I get in my 500,000 faster, and I get away with less insurance. If this was whole life, you'd have to have more insurance. The spigot on the bucket would be bigger. That's why if whole life even earned 8%, you're going to be lucky by age 95 to net 5.9. Here, I can earn 11 and net 10 within 10 years, okay? So that's why I prefer Indexed Universal Life. It was designed for living benefits. So what's happening here? Once I get 500,000 in there in 4 years and 1 day, with the level death benefit, if I die, what are they going to pay out? $1 million. not $1.5 million. I didn't choose the increasing because that's not what my objective was. It's still a great rate of return if I die. They're going to pay out $1 million, but $500,000 of that is my money. But the insurance company, after 4 years and 1 day, is only charging me the cost of insurance that they're charging me for is only for the remaining net amount of risk, the remaining $500,000. They're not charging me for $1 million, and yet these agents out there who don't understand this, they go, oh, this thing's just going to implode. This thing's going to be so expensive. They're assuming the insurance company is going to keep charging you for $1 million of death benefit. The net death benefit is only now $500,000 because $500,000 of it is your money. Is this making sense? The cost of the insurance is now half of what it was, even though you're 5 years older. It's just, and the interest on $500,000 is so much greater than the cost on the net amount of $500,000 that's remaining. So what happens? Well, historically, like I said, I've earned 11 and netted 10. Let's just say ever since 1980, even before Indexed Universal Life, I've averaged 9.62. 9.6, let's round down to 9.6, divided into the rule of 72 means your money will double every 7.5 years. Now, I have netted in excess of 9.6, but let's just use that. That means in 7.5 years, which after 4 years and 1 day, you add 7.5, that's 11.5 years into this policy. That 500,000 now has doubled to $1 million. Wait a minute. So I have $1 million of cash value, and the death benefit is $1 million. If I died, what would they pay out? Technically, $1 million, but actually Teffer and Deffer says, well, they will pay out 5% more. So if you died, they'd pay out $1,050,000. The point is this. The cash value has equaled the death benefit. So the cost of insurance now is nothing, or it's very, very small because it's only 5% greater than that. But $1 million of that is your own money. But if you die, they'll pay out $50,000 or 5% more than that. But they're only charging you for the cost of $50,000 of insurance 11.5 years from now. Even though you're 11.5 years older, the interest on $1 million is this compared to the cost of $50,000 of life insurance is only this. So the actual cost of insurance is getting cheaper as you get older because the net amount at risk is hardly anything to the insurance company. So far, so good. Now, with that snapshot of time, if you got $1 million in there, you could easily pull out $100,000 a year tax-free without depleting your $1 million if you live to be, 120 based on actual historical performance. But let's say you don't need the money yet. So you let it sit for another 7.5 years. So in the 18th and a half year of this, the $1 million now has doubled again to $2 million. So now you have $2 million of cash. The original death benefit was $1 million, but if you happen to die at that snapshot in time, the insurance company is going to pay out $2.1 million, 5% more than the death benefit. But the insurance company is only charging you for $100,000 of life insurance. And where can you afford to do that in 18 years? Well, the interest on $2 million dwarfs the cost of $100,000 of insurance. So this insurance is getting cheaper as you get older. Now, some people say, I've never seen an insurance policy that gets cheaper as you get older. Well, then you haven't seen one structured like this. This is what we call self-insurance. You are becoming self-insured. You get these advisors out there that don't understand this, and they say, oh, no, you should buy term, invest the difference. Because if you buy term and invest the difference, which I was a big proponent before Universal Life came out, then if you invest the difference, assuming a nice 8 to 12% rate of return, and 30 to 35 years from now, your investment will equal or exceed the death benefit in 30, 35 years, and now you don't need the insurance anymore. Well, it's interesting how many people still keep the insurance, even though they don't need it anymore, because inflation and everything else, they still want to leave behind a tax-free death proceed. But they now have the cash. But it took 30, 35 years. I have the cash in 11 years. If you structure an IUL like I'm talking about, you'll be self-insured in 11 to 15 years. Your cash value will grow to equal and then exceed the death benefit. So what is so good about a whole life policy that makes sure that this death benefit up here, the cash value, okay, that there's guarantees in there that keep this death benefit in force? It's because whole life is so doggone expensive that the interest and this growth on this cash value will never, for a long, long time, be enough to cover this death benefit. So they have to have these guarantees in there. And I'm going, I don't need any guarantees when my cash value exceeds the death benefit within 11 years. Why do I need that? So all of the benefits that are touted by, like whole life agents about guarantees, I don't need those guarantees because my cash value equals and exceeds the death benefit. I'm self-insured within 11 years. I don't have to wait until I'm age 95 with a whole life policy to have a net rate of return be within 2% of the gross rate of return. And frankly, I can earn a better gross rate of return with IUL than I can whole life, okay? So folks, this is an incredible instrument. And if you want to learn more about what I'm talking about here, it would behoove you to study this book, The Laser Fund. It's 300 pages, jam-packed with information. And if you're a left brain learner, this white covered side is about 200 pages, which is 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, I'd recommend you flip the book over and read the orange covered side. That's about 100 pages, 12 chapters with 62 actual client stories of how a properly structured max funded IUL is the dream solution, not just for retirement, but college funding for your kids and grandkids, real estate management, working capital for business, an emergency fund, pension maximization. If you're a school teacher, police officer, or firefighter, a lump sum capital transfer, all kinds of goals. I call it a financial Swiss Army knife. If you want to use your whole brain, read both of these books. But this isn't about me. This is about you. And so I want to gift you a copy of this. It retails for $20 on Amazon. If you buy one on Amazon, thank you. But I'll gift you a copy. So you simply go to laserfund.com or click on the link below. You just contribute towards the shipping and handling. I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. While you're in there claiming your free copy of this Laser Fund book, if you like to listen and learn or watch and learn, there's those options there too. You can also register for an educational webinar. They're free. We do them on a weekly basis. More importantly, you can even schedule an appointment with no cost or obligation to talk to an IUL certified professional to see how a properly structured laser fund can be set up for you to achieve your goals. Because if you don't go to a certified professional, I'm a little bit afraid that you will not see your IUL perform like I've been talking about. And you don't want to go 5, 10, 15 years down the road and go, how come I'm not self-insured yet? Oh, it's because you had your nephew or your brother-in-law set it up because they had an insurance license. That doesn't mean they knew what they were doing. And I've seen that sad story so many times. So claim your free copy, set up a time to talk to a certified IUL professional now. This is about you and your brighter future.